Hello and welcome everybody. In this episode, we will talk about technology and mathematics of money. Money is far more than a paper or numbers on a screen. It is one of the humanity's earliest and most profound technological inventions. Initially, money was created to solve the inherent problems in a barter system. However, since then, money has evolved through various forms, from shells and precious metals to paper and digital currency. In this episode, we explore the evolution of money and the technology behind its creation and security, as well as various mathematical principles such as compounding interest that allow money to grow over time. We will talk about what does it mean to be wealthy and how wealth could be accumulated. We also will examine the modern investment vehicles such as stocks and cryptocurrencies, even talk about tax laws and governmental policies that shape our financial lives, specifically in the United States of America. Understanding these topics not only provides insight into how money functions in our society, but also illustrates why trust in institutions, in currencies, in technology is fundamental to a nation's economic well-being. First, let's discuss the origin of money. The very existence of money can be traced back to the inefficiencies of a barter economic system. In a pure barter system, individuals exchange goods and services directly, but this system had very big limitations. Just imagine try to barter labor for food where there isn't a mutual coincidence of interests, a scenario that could make even simplest transactions cumbersome. Money was invented as a universal intermediary, a technology, if you will, that facilitated trade by standardizing value of goods and services. Historically, early civilizations adopted various items such as salt, cattle, beads, shells as mediums of exchange. Over time, precious metals like gold and silver became the preferred standard due to their inherent rarity, divisibility, and durability. The use of these metals is not only streamlined trade, but also laid the groundwork for what we know as the gold standard, a system where a country's currency had a value directly linked to gold. Although the United States and many other developed countries eventually abandoned the gold standard in the last century, its legacy for some reason endures, in part as a testament for the search for stable and reliable monetary systems. Let's talk about money and the role of technology in the evolution of money. Even in ancient times, technology was used to ensure that money was unique, easily recognizable, and resistant to counterfeiting. Rulers and governments developed intricate methods of stamping, engraving, and later printing to guarantee the authenticity of money. The transition from physical coins and notes to digital money today is represented by sequences of ones and zeros on computer systems, demonstrates a continuing evolution of money's technological underpinnings. Today, our financial lives are dominated by digital transactions rather than paper transactions. Whether you're trading your labor for money or using money to buy goods, you're part of a vast interconnected system that relies heavily on technology. Despite the seemingly intangible nature of digital money, our entire economy depends on it. and its stability is underwritten by complex cryptographic techniques, secure digital protocols, and software. Money in today's world is very deeply intertwined with computer systems. We are living in a digital age. Over the last few decades, the physicality of money has been gradually replaced by digital representations. Most of the currency circulating in modern economies is stored as electronic data in bank accounts. We trust these computer systems, often hidden behind layers of encryptions and maintained both by government and private organizations, to manage and secure our wealth. Similarly, the stock market also operates in a digital environment. If you watch some of the older movies with traders being on the floor, waving pieces of paper, those times are long gone. Trading stocks is a process of transferring digital records that represent ownership. These transactions are executed by automated, highly sophisticated systems that require precision and reliability. In such a system, any bug or an error could lead to severe consequences, underscoring why trust in our technology and regulatory systems is paramount for our society. Let's talk about stocks. Stocks, at its core, is a system where buying a share means giving a company capital, in other words, your money, in exchange for a claim on its future growth and future profits. This capital allows companies to invest in production, research, and expansion, ideally leading to an increased company value over time. Therefore, your shares also increase in value over time, building your wealth. When a company performs well, the value of your investment grows accordingly. Stock exchanges are simply platforms where these transactions can occur, and they function reliably only because they're built on trust that investors place in both private companies and governmental regulation, as well as transparency of the stock market. Investment vehicles such as 401k plans that allow people to build wealth for retirement age further demonstrate this process. They allow anybody, all of our citizens, to invest in stock, in other words, invest in companies that create goods and services, to accumulate wealth over time through various long-term strategies, such as compounding interest. These systems underscore the role of technology and mathematics in the modern economy as it relates to money. In modern times, a person can even own fractional shares, further allowing many more people to participate in stock market. In other words, all these enhancements, they democratize the process of building wealth across the entire society. Let's talk about cryptocurrency next. There's often a debate that I hear. Is cryptocurrency an innovation or speculation or both? In recent years, maybe decades, cryptocurrencies like Bitcoin have entered the mainstream discussion as an alternative investment. Proponents of such investments claim that cryptocurrencies represent a modern, decentralized form of money hidden from the government to some extent. However, when evaluated against traditional roles of money, serving as a medium of exchange or a store of value, the logic seems far less obvious to me. Cryptocurrencies are primarily digital tokens that exist on blockchain networks. And while there's a set of technical merits, their practical function as money or as an investment is heavily debated. Most cryptocurrency exchanges operate very much like banks. They accept deposits in the form of cryptocurrency. They lend out the digital currency that they maintain, and then they charge interest on those loans. Critics argue that this structure resembles a form of loan sharking without the transparency and regulatory oversight that is found in the traditional banking systems. Banks are heavily involved in making money by providing loans as well. But that financial system of regulatory requirements is much more heavily regulated by the government, thus building underlying trust in the entire system. For example, banks must report large transactions to the US federal government, whereas crypto markets often operate in somewhat, you could say, shady or in general much less transparent environment. Lately, government was trying to regulate cryptocurrency, but in my opinion, somewhat late, but also not as efficient as US government regulates banking system. I feel like in part that is a function of the time we live in. Banks have been around for centuries, and government had time to figure out proper regulation of that industry. The same applies to stock market. Because cryptocurrencies are fairly new, I feel like our government, as well as other countries' governments, have to evolve with the technology of cryptocurrency to create regulation that is not prohibitive to conducting business, but allows people that quote-unquote invest into cryptocurrency have at least some amount of assurance that their money is not being stolen or misused. This kind of opacity that exists in crypto markets, combined with the fact that crypto investments rely on finding new buyers rather than generation of tangible wealth through production of goods and services, leads many people, including me, to approach these assets with extreme caution. If you talk about my personal beliefs, at this point, I would never invest my own hard-earned dollars into cryptocurrency. On the other hand, however, cryptocurrencies offer extreme independence from a government oversight. And some people argue that that is the entire strength of cryptocurrency, allowing people to exchange money without an oversight of a banking system or regulatory system. What that leads to, inevitably in my opinion, is use of crypto to conduct criminal business. And I feel that that is simply inevitable. Not to say that dollars or digital money or bank accounts cannot be misused for the same purpose by another criminal enterprise. Now let's talk about math. Math has fascinated me since I was a little kid. I really enjoy the certainty of looking at formulas, looking at mathematical exercise, and knowing that there is only one right answer which is definitely not the case in life, broadly speaking. One of the most powerful forces in personal finance is the principle of compounding interest. Oftentimes, it is described as the eighth wonder of the world. Compounding occurs when the return on investment begins to generate their own returns. Mathematically, even modest interest rates can lead to exponential growth over time. For example, an initial investment that doubles every decade will grow significantly over a span of 30 or 40 years. So-called rule of 72 is a quick, useful formula that is popularly used to estimate the number of years required to double the initial investment at a given annual rate of return. Alternatively, it can compute the annual rate of return of compounded return from an investment, given how many years it takes to double that investment. To calculate the time period the investment will double, divide the integer 72 by the expected rate of return or an interest rate. This formula relies on a single average rate over the life of the investment. The findings hold true even for fractional results, as the decimals represent an additional portion of a year. Rule 72 serves a very useful mathematical approximation. Give you a specific example. Let's say you roughly make about 7% return on your investment in stock. If we divide 72 by 7, we get roughly 10, which means at 7% return, your money, your initial investment, through the magic of compounding interest, will double in 10 years. The phenomenon of compounding interest is not only a cornerstone of modern investment strategies, but also highlights the intimate relationship between mathematics and technology. STEM education, particularly in mathematics, plays a crucial role in understanding many financial concepts, empowering us as individuals to make informed decisions about our wealth, growing our wealth, and investments in general. Many financial advisors and economists advocate for a stronger emphasis on STEM education to ensure a future generation can harness the full potential of compounding interest in building wealth, as well as getting basic financial education as early as high school or even middle school, alongside with mathematics, engineering, and technology, which is what STEM acronym stands for. As you make money, inevitably you will find out that the government wants a portion of it, calling it taxation. A key aspect of any discussion about money is the way in which government policies and tax laws influence the flow and distribution of money. In the United States, the tax system differentiates between long-term and short-term capital gains or gains from stock investment, sometimes taxing them at rates lower than those applied to ordinary income. Ordinary income essentially is money you earn by work. This tax treatment has led to debates over fairness. Famously, Warren Buffett once highlighted that his secretary, earning a fairly modest wage, pays a higher tax rate than he does, even though he is a billionaire, on his investment income or income from selling stock. Such disparities prompt discussions on various tax reforms. Some propose a simplified system where capital gains are taxed as ordinary income. I am one of the people advocating for such change. Those people argue that this would create a more equitable structure. Additionally, while the idea of taxing unrealized gains, assets that have increased the value but have not been sold, is technologically appealing, The current systems and data infrastructure make it challenging. Instead, one alternative is to tax loans taken out against collateral, such as stock or real estate, once they exceed a certain threshold. This approach could more directly target wealth accumulation without penalizing everyday investors. This is one of my personal ideas, as I feel that current tax system that has been around for a very long time needs a little facelift to keep up with ever-changing landscape of continuously inventing new financial vehicles, new way to exchange money, new way to purchase or sell stocks. All those things should be accounted for when creating a government policy as it relates to taxation. From a mathematical perspective, these policies can be analyzed to understand their long-term effects on wealth distribution. Evaluating the math of taxes involves complex modeling of income, investment returns, spending behavior, a task that underscores the important role that mathematics and mathematical education plays in the design and assessment of fiscal policy. The same should be said for us, ordinary Americans, making our own financial decisions, whether it comes to purchasing a home or investing in stocks or even changing jobs. Without a foundation in math and basic financial educations, I feel like some people are placed at a significant disadvantage. That is why I'm personally a big advocate in making a basic financial education a mandatory course in the public high schools. I would like to mention something called progressive tax system that United States and many other countries employ. What it means is that the more money a person makes, the higher tax rate will be for that person. This is very common in many countries around the world due to fundamental fairness of that approach. This way, richer people contribute fractionally more money to the government coffers, so government can provide goods and services that many people expect it to. That even goes as far as providing security, such as police force or an army. I would like to talk a little bit about states, namely you could say Texas or Florida, that don't have state income tax. Instead, they rely on sales tax to fund the state government and its important programs. In my opinion, this type of taxation, although appealing on the surface, is fundamentally unfair because it is, at its core nature, is regressive rather than progressive, meaning that people with lower incomes spend a larger fraction of their income on taxes. Again, math does not lie. Now let's talk about loans. Everybody sooner or later, unless you were born extremely rich, will take loans. Loans is a critical component of modern financial system in the United States. Their structure is deeply rooted in mathematical principles. When a loan is secured by collateral and interest is charged, it is calculated using well-defined formulas, and generally speaking, in this way, the lender allows its money to grow even as it's borrowed, whether through mortgages, personal loans, or other forms of credit. The idea of using the technology to potentially reclassify certain loans, for example, those made against high-value stocks or real estate, as personal income, has been floated as a way to ensure that the wealthiest individual contribute a larger share of their wealth in taxes. Although this proposal is largely theoretical and likely will never pass the Congress, it represents an innovative approach to modernizing tax policy by harnessing both technology and mathematics to better track and evaluate financial decisions. In summary, money is not just a tool for exchange. It is a sophisticated technology that has evolved alongside human civilization for millennia. Its history is a story of innovation, where each step, from barter to precious metals to digital currencies, has required advances in both technology and math. Trust in government and institutions is paramount to money. Without it, even the most advanced monetary systems will fail. For individual investors, the lesson remains clear. While modern investment vehicles like stocks or real estate offer opportunities for growth through mechanisms such as compounding interest, there is no substitute for steady accumulation of wealth through disciplined investing. In a society where trust in government and regulatory bodies may be waning at times, it becomes even more essential to participate in democratic process. Vote, stay informed, invest wisely, and hold your government that is there for you accountable for the decisions that are made. Ultimately, money remains a technology designed to ease the burdens of barter and enable a complex web of economic interactions between companies and people. As we look to the future, continued investments in technology will undoubtedly bring new forms of money and new challenges in maintaining trust, fairness, and stability of our society. Until then, our best defense is to understand these systems, make informed decisions, and advocate for policies that promote transparency and equity in the financial realm.